Dara Albright is one of actually, I can say a good friend also, but she's a contributor to the Fintech World on the Fintech industry, and a lot of people know her, and a very credible person and academic. We're one of the people that actually I admire in the business since 2012 that I've been involved. Dara's going to come and just take it over then. Dara, please. Dara Albright, give it a head. Thank you. That's
yeah.
We're ready. No problem. Just take it. By the way, we have almost 10,000 people watching us online, so anybody want to say hello, Mom, is fine. You can come in the front.
Wait, hang on, Sydney?
Yes. Are you have a Mac?
Yeah, no, I don't have a Mac, so.
Okay. Is it right? Which one is this?
I do.
Okay, good. We're fine. Hold on. That's fine. Okay. Oh, great. We're right there. Good.
Is it working?
Yes.
Okay. Okay, that was easier. How's everyone doing? Good. Well, first I want to say, Sydney, thank you so much for the great introduction and for having me. I always love participating in your events. You always draw such a great crowd of people that not only go on to become trusted business colleagues, but people that I could also call friends. So thank you very much for that. For those who don't know me, my name is Dara Albright. I talk and write a lot about the technological and regulatory innovation that is disrupting and reshaping financial services. But for those of you who even know me probably do not know that I am also very enamored with an era called the Roaring Twenties, the 1920s. In fact, I have went as a flapper for probably about 15 Halloweens in my adult life. And as someone who really just loves studying the history of market cycles and economic cycles, economic booms, what makes them tick, I've just found this time period especially to be particularly interesting. It really marked the beginning of consumerism in the United States, and also at that time too, there was a middle-class economic boom unlike anything other that we witnessed before. So I actually spent years trying to understand why. And about 10 years ago, I came up with this hypothesis that it's been invention and mass communications that's been the impetus for stock market growth and economic prosperity for really the last 100 years. So essentially the theory goes, the radio inspired the great Roaring Twenties in the 1920s, television, the next big bull market, 47 to 57, the internet in the 90s. And what did they all have in common? Well, each one was a new invention in mass communications that created a more meaningful and dynamic way for brands to engage consumers. And essentially, when consumers were engaged, they're spending, they're buying. When they're buying, sales are going up, revenues are increasing, stocks are rising, companies are hiring, and economies are booming. So really just as simple as that. And, and in December, when we were kind of approaching the new year or the new decade, not only was I getting excited to whip out my flapper costumes, I was really starting to think, is this going to be the next Roaring Twenties? And I started thinking really a lot about blockchain technology, because that has been my focus. And does blockchain have really the power to inspire another roaring 20s. So what I wanted to kind of talk about today is a little bit about that and blockchain technology. We all know right now that blockchain technology is changing the world. It's rapidly defining, how we invest, why we invest, what we invest in. It's changing how we raise money, how we borrow, how we lend, how we pay for goods and services, how we save for retirement. It's reinventing currency. It's democratizing access to capital. It's giving rise to new financial leaders. It's changing even the way all the products that we consume are produced and distributed. There's not one person or business on this planet that is not going to be impacted by blockchain technology. But will it inspire a period of economic prosperity like we witnessed 100 years ago? That's the question. So I think to answer that question, we really need to look at some of the trends that we're seeing now. And one of the ways to do that is really pay close attention to the people in the ecosystem. What are they saying? What are they doing? Their words and their actions. What are regulators saying? Government officials? What are financial advisors saying? Modern investors, corporations, venture capitalists. And then also really paying attention to what's happening in public finance. So there's some interesting shifts going on that we're going to talk about today. So I actually spent the last year really attending a lot of events like this and talking to a lot of people and hearing what they were saying. So this is a lot of what you'll hear today is coming from, these are actually words coming from regulators or speaking at events or venture capitalists, financial advisors, et cetera. So first, let's talk about the regulators. What are they saying? Well, right now we're seeing regulations are catching up to innovation, and that's happening globally. We're seeing, blockchain and digital currency regulations are introduced and implemented all across the globe, on an international level, a national level. We're seeing a lot of legislation being introduced as well as on a local level. Basically, the essential question that all these jurisdictions are trying to figure out is they're trying to figure out the smartest framework that would protect individuals without impeding innovation. So this is actually at EisnerAmper, we put together a global regulatory tracker. You're welcome to go visit that link and check out the site. I mean, we really, trying to capture and keep track of all of the regulations that are being introduced all across the planet in the space. So feel free to check that out. I just wanted to highlight a couple that I think are really interesting because I think that they're pertinent to today's discussion when we really focus on individuals and retail investors. And you could read this, and I'm happy to send out a copy of the presentation because I don't want to go into so much detail. But some of these I think are really interesting. One is the Token Taxonomy Act was introduced in the House that would actually remove cryptocurrencies from being defined as securities at all. That could potentially transform corporate finance. Another bill recently introduced just last month of the Virtual Currency Tax Fairness Act. And that's interesting because it will exempt some capital gains when crypto is being used as its utility to actually purchase goods and services, but under a certain threshold, in this case $200, which is interesting as well to see how that will pan out. Keep in mind also that these are federal legislation, so it's highly unlikely anything is really going to get done, probably for quite some time. But what's interesting is there's a lot that the SEC could do under its existing mandate without having to wait for new legislation to be introduced. One is a piece of legislation that was actually introduced that would be broadening the definition of the accredited investor. Now, the SEC came out recently also calling for comments on broadening the accredited investor definition. and, basically making it more knowledge-based and experience-based as opposed to wealth and financial-based. I think this could have enormous implications. Ultimately, it'll be interesting to see if they take it really to the next level and eliminate the rule altogether, which remains to be seen. Even Commissioner Hester Peirce alluded to that in some public statements recently. But something like that can really stabilize markets. It'll foster diversification, and we're going to talk a little bit about that later because it's so important to enhancing portfolio returns and decreasing correlation among asset classes. I mean, essentially what you're doing is you're just really, you're making the capital markets, improving them. You're just making them so much better. There's also recently, Commissioner Peirce came out with the token safe harbor proposal, which would give crypto projects and ICOs a way to raise capital without without worrying as much about, is this a security or is this not? And kind of coming out with a little bit of more guidance on that. So it remains to be seen how that will pan out as well. But all this is really designed to enable us to reach out to individual investors, because if you look at just the rise of the cryptocurrency marketplace, it's all about, the industry was founded by retail investors. It was founded by individuals, techies. It wasn't a Wall Street product. It wasn't founded by institutions. It was a market that was created by individuals, and the two key fundamental characteristics of that market is that it's liquid, that make it attractive is that it's liquid, and that it's accessible to everyone. We're seeing governments now, I'm sure you've probably read about this, all looking to, searching for ways to digitize their own currency. So we'll see how that pans out. It was interesting, especially after Facebook announced the launch of its Libra initiative, to see all these governments coming out and central banks talking about, what are we going to do now? So it's going to be interesting to see really how that starts to unfold. Financial advisors, what are they saying? So this is really interesting. I was at, recently, I was at TD Ameritrade, did their big annual RIA financial advisor event, and they had a whole day dedicated just to talking about digital assets and blockchain. We had really, really interesting conversations, and these were some of what we've heard there. And it was interesting because I would say that about a little over a year ago, I was at a conference with a lot of the same people, and the first question they would ask is, who here has, owns Bitcoin, has, is following, and most people did not raise their hand. Questions would be, are you putting your clients in Bitcoin? You don't see many hands go up. This year, you really notice a significant change. So here's some of the statements that came out of that. First, they're talking about now, whereas a year and a half ago, it was, no, that's too risky, it could be an exciting market, but, you can't, take the risk. Now, the conversation has changed to the benefits of a 1% Bitcoin, to have at least 1% Bitcoin allocation in your portfolio far outweigh not having any exposure to this asset class at all. Advisors already believe that their clients are investing in crypto outside of their advisory relationships, so they know it's already happening. 6% of advisors have already placed digital assets in some way in clients' portfolios, but more significantly, 13% plan to do so in 2020. And what is the number one reason? Well, the number one reason is because they're looking for asset classes that are less correlated, and we'll talk a little bit about that in a second because it's really significant. Most advisors are really waiting for an ETF, a qualification of the ETF from the SEC. We'll see how that pans out. And I love this quote. So the head of digital assets at TD Ameritrade, said Bitcoin is making saving and investing sexy again, and that's what they're seeing there. And you're seeing all these firms, even major financial institutions now adopting digital asset divisions. But I thought this was the most persuasive argument by Rick Edelman, who is one of the a leading RIA in the country. And he said to the people, he said, look, even to the naysayers, he said, even if you believe this is going to zero, if you think this is like, a whole bunch of BS, he said, don't ask yourself what you think. He said, ask yourself, what you think other people think. So if other people believe that, that it's going to the moon, how is that going to impact? It's really what they're doing. So I thought that was really interesting. And the fact is, we're seeing that today's investors are really clamoring for these products. 5% of Americans, these are just some of the stats, already own Bitcoin. It's the 5th largest holding by millennials. In fact, I saw a stat somewhere recently. It said millennials actually trust Bitcoin more than they trust U.S. Treasuries. So that's kind of interesting. And we are seeing, an imminent transfer of wealth. 30 trillion is going to be going from baby boomers down to these younger generations. You may not know this, but today there are actually more Coinbase accounts than there are Charles Schwab accounts. And this is really interesting. Digital assets even appeal to investors as young as 7 years old. I was speaking at a conference this past September, FinCon, and there we were talking about building wealth outside of Wall Street, and there was a little girl in the audience with her mom. She was 7 years old, sitting there taking notes, like diligently taking notes, and she and her mom came up after and said, she's talking about her daughter's just been so fascinated with this industry and like wanted to come to this event and and hear these presentations and learn. And we're also seeing just even some innovation, in the wallet space. We're seeing there's a company that's going to be coming out with digital wallets geared just towards young generation's children. So it's really interesting to see how that's all happening. What are financial firms saying? Well, TD Ameritrade, they put on that event a couple of weeks ago and had a whole day just focused to blockchain and digital assets. They have a new division that's just focused on digital assets. JP Morgan is in merger talks with Consensus. Here's Jamie Dimon. He's not calling Bitcoin a fraud anymore, I will tell you that much. We're seeing more and more institutions really, building their, I would say more than dipping their toes in the crypto waters. I think that they're getting much more involved even than we hear probably in the news. So we're seeing really significant movement from, firms that and then, even just major corporations. Blockchain is not only reinventing finance, it's, making businesses across the planet more efficient. It's adding to the bottom line. The perfect case example, have you guys heard of the Mango Project? So the Mango Project was an initiative that was done with Walmart and IBM. And essentially, Walmart head of food safety had a big meeting in their conference room, and he handed each person at the meeting a mango and said, "I want you to tell me the origin of this mango." And as you recall, and especially recently, there's been a lot of issues with the romaine lettuce scares and getting back to the origin of the product. So they did it with the mango test, and they came back. It took like 20-something days to find out the origin of that particular mango. So that's 20 days of food sitting on the shelf that is potentially contaminated. Or what they end up doing is taking all of the food off the shelf and losing money. So they did a test with IBM and put it all on, basically put the supply chain on the blockchain, and it took them basically 2 seconds. to figure out the origin of the mango. So that's really just transforming businesses, and you could just see the impact that that's going to have. Coca-Cola's in the space. I mean, there are so many big names that, the big corporate names that have been around for 100 years that you never would, associate with blockchain, but they're there. What are venture capitalists saying? They're saying, and these are actually some word from venture capitalists at a recent event too, Digital Asset Strategy Summit. They're saying the biggest migration of talent is going to crypto startups. VCs are investing in this type of disruption, looking to sell to incumbents. They're seeing, I think most importantly, the number of deals in the space increasing, the size, but most importantly, the quality is improving. They're seeing better governance, better deal flow, and more intellectual capital in the space. So why is that important? Well, first of all, we are expecting billions to be unlocked in the IPO markets just this year. So we're seeing, there are going to be significant exits for venture capitalists. Here's just a sampling of some. With so much talent and so much interesting deal flow in the crypto and blockchain space, I think it's very highly likely that we're going to see, a significant portion of those venture capital exits going into the blockchain crypto space. So that's when now we want to just talk a little bit about the IPO markets, the public markets, and sort of seeing some of these incredible shifts. So while we're seeing deals getting done and potentially all these exits, the IPO market is still broken. These deals, they're getting done, but they're going public at so late stages in their life cycle. Unlike years ago when, you have a company like Intel that goes public in 1971 at a $58 million valuation, that was it, raises $8 million on its IPO, and individuals that have had the opportunity to invest in Intel's IPO and who had held it realize, 100,000+% return. And we don't see that anymore because companies, instead of appreciating in the hands of, the general public and the retail accounts of the general public, they're appreciating, in the hands of venture capital funds. So the market is still pretty broken, and I think we're really seeing blockchain and the rise of digital assets play a significant role in remedying that. So that brings me a little bit to the evolution of public offerings. And I'm not going to go through the whole thing, but what I find is really interesting, it's actually a really cool slide. The first IPO in the U.S. was 1783, and that was the Bank of North America. There was no SEC, there were no federal law. I mean, anyone could invest. Anyone had the opportunity to invest, and it was basically regulated under state laws. Then, of course, 1933, the SEC emerged. And then we saw, the NASDAQ IPO came to be. We saw a lot of alternative IPOs, backdoor IPOs, reverse mergers, SPACs. The internet IPO was a game changer in the 90s. And then we started to see something really interesting happening in the late 2000s called this concept of crowdfunding. You saw the emergence of these platforms like Kickstarter and Indiegogo, and it was basically people pre-selling their products. Rewards-based crowdfunding. You get the product was your reward. You weren't getting equity into the company, but you were getting some other kind of benefit, other kind of utility, if you will. And that was really interesting because that sort of watching how that was starting to happen almost became a little bit of the genesis behind the introduction of the Jobs Act back in 2011, and which was signed into law in 2012. And then it was, okay, well, let's find a way to legalize crowdfunding or do it, under our securities framework and make it, economical for issuers to, to raise capital in our existing framework, but in a way that, we could, add a little, some other exemptions. So we could actually enable them to do this, reach individual investors, reach the general public, but in a way where we could also kind of oversee it and manage it and, mitigate fraud, et cetera. So that was kind of the start of securities crowdfunding. The bill, the way it needs work. I mean, it's no one would deny that. But an interesting component that came out of it was Reg A+. And we are starting to see, interesting things happening in the Reg A+ space. And then, that kind of evolved. We saw the ICOs, and then it was, hey, you can't do this. This is all completely illegal. And then it was, oh, wait, let's just do it under our existing framework, and we'll call it a security token offering. And what they did was actually very interesting. People started doing security token offerings, under the existing framework using one of the exemptions. Many were using the Reg D exemption. Unfortunately, the issue is that kind of defeats the whole allure of what this market was all about. It was about liquidity and access to the general public. So Reg D defeated that whole purpose. So then, issuers started trying utilizing the Reg A+, and going and filing with the SEC to do a Reg A+ token offering. And unfortunately, the SEC was dragging its feet, not qualifying any of these. So that was creating a little bit of a hurdle. Until just actually this past summer, the SEC is so far qualified too. I think that's significant. It's something to really track and see where that goes, because that will, it all depends how these things perform in the aftermarket. We now know these deals could get done. Just like IP, we know the deals could get done. Great, you could get it done in the initial offering, but it all depends. If there's no aftermarket, if there's no excitement, over these, these products, and there's no aftermarket for it, then no one's going to care. So we have to really, that's really the thing that we need to see now. The unfortunate thing is that the SEC is yet to qualify a platform, an ATS for trading digital assets in secondary markets. So that's something that we're still waiting for as well. Now, what I think is the most promising area in this whole space is asset tokenization, where this is all headed. And I think that this is just completely going to redefine everything that we know about public offerings. I think we're looking at kind of the public offerings of the future. Where we're headed is they're going to be something completely different than what we see now. They'll retain a little bit of the characteristics of the equities and the type of products that we know, but I think we're going to see products that are digital. We're going to see hybrid products. They're not just going to be equity or an ownership stake in a company. There's also going to be a utility component. You're going to be able to, actually be able to buy things within that network. And maybe even outside of that in other networks. So there's going to be an actual currency related to it, or another value component, utility component. I think some of these products, many of them probably will not even come through bankers. Instead, I think they're going to come from issuers directly. They're going to come from individuals. They might not even be companies. It might be maybe it's going to be my home, my car, my, other assets that I own that I may want to tokenize and capitalize on and sell a piece of. And that's asset tokenization. Here's asset tokenization in a nutshell. It's basically the process of converting the rights of an asset into a digital token, which is stored and managed on the blockchain. like I said, it's real estate, it's your home, it's art, it's wine, it's cars, it could be my employment contract, a contract with a sports team, business, a store, a venture capital fund, a movie, what have you. And there's so many benefits to this. I mean, what we'll be seeing is greater, more democratized access to capital. These markets are 24/7, available to everyone. We're reducing transaction costs, increasing liquidity, and they're just. But the one thing that I want to focus on is that the number one benefit, the greatest benefit of asset tokenization, is that it's going to be fueling an endlessly proliferating universe of these little digital micro investments. And what that will be doing is creating the greatest diversification opportunity in the history of mankind. So imagine all of us start tokenizing our homes, our art, our contracts, our film that we make, our boats, what have you, creating this out of that. People have an opportunity to take their portfolios, because we know, the modern portfolio theory, which was, emerged in the 1950s, tells us that diversification is really the most proven portfolio theory for mitigating risk, the most productive and efficient theory for mitigating risk in the history, in the history of mankind. Just simple concept, don't put all your eggs in one basket. This is an opportunity to, I mean, it's unprecedented amount of diversifications, unlike anything that we've ever seen before. And, what that's actually going to do, people look at right now, we saw in that earlier slide that what were financial advisors looking for? They were looking for low correlation. That's what they're looking for, because they understand the concept and the power of diversification. But right now, we have all these different asset classes. We have gold, and we have equities, and we have bonds, and we have, markets in all different parts of the world. And, if you think that these things aren't tied together or correlated, you're kidding yourself, because you have, the institutions are trading these things. And, sometimes they're trading stocks, and they'll be selling stocks. It has nothing to do with the fundamentals. It's because they have to, liquidate that because they have to get out of another position, or fund something else. I mean, and sometimes it has absolutely nothing to do with the fundamentals. So we need to go back. We're going to see, with the rise of asset tokenization, asset classes that are truly, truly uncorrelated. And it's interesting to see, when we see issuers becoming investors, investors becoming issuers, becoming one, money is going to be distributed more evenly. And I think that ultimately it's going to inspire more innovation, it's going to fuel better products, stronger businesses, more jobs, as well as greater confidence in the capital markets. And I do think that this very well could become the most productive risk mitigating strategy since the advent of the modern portfolio theory. And at the event that I was at a couple of weeks ago, TD Ameritrade, this was great, was on a panel with Gabor at Van Eck, and he said tokenization could potentially create an economy north of $100 trillion in value. So, will blockchain be as important as the radio is still the question. So, I think that it is far going to exceed the importance of the radio when we see it. The radio fueled unprecedented consumption. It led to stock market growth and a booming economy, yes, in the 1920s. But I think blockchain is a little bit more like the wheel. The wheel is something that really paved the way for an economy to even exist at all. It created, the mechanism for you to transport goods, and, from long distances. So that's really kind of more of what blockchain is actually doing now. And not only is it giving birth to a new financial system, at the same time, it's empowering all of these businesses across the globe. It's making them more efficient. It's adding, dollars to the bottom line. So I think, history will tell, but I think that it will be more significant. So I try to use a little bit of 1920s slang here. So I'm very excited. I'm very optimistic. So I will say it's a good time to celebrate with the giggle water, because that's what they used to call alcohol in the 1920s. And I tried to practice the 1920 like old New York drawl, but I'm not very good at it, so I'm not going to do it here. But I do think that this decade is really exciting. It could be the bee's knees, another slang from the 1920s, and an incredible opportunity to make some digital clams. So thank you very much.